I wanted to use the concept of almost that non-directional type trading to be in the market using different concepts to be able to take advantage of the markets as they're trading. So we'll go through what they were. As I said, mainly concentrating on trend following, counter trend, and pattern recognition. So they were the three key areas of focus for me developing the system and strategy up. So I wanted to make sure, at least if I was trading, I could take advantage of either one of those, and we can almost put in there, which I haven't got in there, cycle trading, so that range bound type cyclical activity. So that became one of the strategies. Now we know good trading systems have a good reward to risk, have excellent money management and position sizing, and a positive expectancy. So they're risking, their average dollars made or taken is greater than their average trade dollars lost, and that they run with a net profit on their account. So we need to make sure that that our systems that we trade and that we monitor and that continue to trade have all of those things going for them. They may not necessarily have a high win rate, because particularly most trend following systems tend to be a lower win rate, and we've seen that in our trading and our testing. They tend to run, probably below 50%, which is, some of you might be a bit surprised about, but some as low as 35. But they have exceptionally good reward to risk. So they're taking, 3 to 1, 5 to 1, so 8 to 1. So they're making $800, risking 100. That's the type of field that you want to be playing on. You don't really want to be playing where you're trading 1 to 1 or worse, where you're risking $200 to make 100. In that kind of environment, you need to be running with a very high win rate, and as soon as that goes pear-shaped, then normally so does your account. So the challenge over the 14 months ago was to develop the following strategies: a breakout strategy that would enable us to be in the market but take the breakout trades as they occur. I wanted to put together a momentum pullback. So one of the keys to the breakout strategy or the trend trader is that these two trading opportunities can come with choppy market conditions. You can get false breakouts, false trend setups. So a really good way to take advantage of increasing your profitability and increasing your percentage win rate and having a smaller risk and a larger reward is to having a momentum pullback. So getting into the market once the market's broken out, but adding positions to that strategy. So that was the momentum pullback. The cycle trader is all about trading support and resistance. So really the cycle trader was developed to take advantage of those choppy market conditions. And what we've found through our live trading and testing and continued live trading and testing is that the higher the tick chart, because we're basing a lot of this information and a lot of our strategy work and a lot of our trading on tick charts, the higher the tick charts, the better the performance on the cycle trader. Also, that strategy works beautifully during the US lunch hour, the European lunch hour, anywhere where there's a potential drop in volatility. That just works beautifully. So counter trend, price action and volume. So we know that we want to use price and volume to be in the market or to make our decisions, because volume's the fuel, price is the reflection of what's happening. So with our counter trend strategy, we're using that combined with our trend trader. So we know if the trend starts to weaken and potentially fades, then we're going to take advantage of that by applying our counter trend trade. And again, so these are working beautifully together. They're designed they almost in some instances work as a fantastic hedge when you're trading. So you'll find that you might, for example, today we got into a really, really good short-term trend setup on the DAX. The market pushed down fairly strongly on about a 202 tick chart. So it's a higher tick chart, not really high, but mid-range. And then what we had on our 55 tick counter trend, we had a nice little short-term buy set up against the trend as it started to weaken and pull back and the buyers came in. We took a bit of profit on the counter trend, and then we resumed the trend back down on the sell. So they just work beautifully together. You know, you will get trades that do stop out, and obviously, and you will have losing days. But you'll see from the results and from the stats that trading the 4 strategies together is just fantastic as far as reducing your risk in the market. So multiple strategies plus multiple markets. So if you think about yourself as a trader and you think, you know, I'm going really well, I'm doing exceptionally well, I'm starting to really get a good run on crude or whatever futures market you're trading, and this is more so for the futures traders, you might find that you get to a point where and this happened to us on the DAX, that you're up to say 8, 10, 14 contracts, you're starting to get a little bit of slippage, happen on crude as well. So you've got to be very, very careful that you don't hit your maximum contracts on a futures market, and you will do on crude, natural gas, soybeans, corn. You know, there'll be a point where you start getting ridiculous slippage because you're trying to get in with too many contracts. So the advantage here is that if you're trading multiple systems, each one of those strategies might have one contract. So whereas before you were trading one system and maybe trading 5 to 8 contracts, this time you're trading one contract on 5 different strategies. And then if you add another layer to that and go, all right, I'm going to add another market, I'm trading crude at the moment, I'm going to add corn in there, then you've potentially got crude oil covered on 5 strategies with 5 contracts. You've got corn covered on 5 strategies with 5 contracts, and you're only trading one contract per strategy. So there's no way you're going to have a problem with slippage due to the amount of contracts you're trading in the market if you spread it like that. And it just allows you to really kind of spread your risk in the market and take out the variable that is slippage. You're still going to get slippage in the markets, there's no doubt about that, particularly when they're breaking out and they're moving very quickly, there can be slippage, but it just means that you're not getting it based on high volume contracts going in. So keys to success with money management. So this is one of the keys that we found when we looked at our systems and looked at their daily performance. So as we stacked each of these systems, so we'll go back one, each of these systems we tracked on the DAX from the 1st of October through till today, and we're going to have a look at how that process went. So the key for us was to look at our drawdown. We wanted to see how much money we could make on max profit or our net profit based on our maximum drawdown. So obviously we were watching the risk on the trade. We want to make sure we stay within our risk parameters, but we also need to make sure that we get the most juice out of the account and without putting too much risk into the account. Now, for trading the DAX from October 2010, we actually had 5 strategies. So I've given the slide here shows 3, but if you're wondering how we did it, basically each strategy has a separate account. So it has a master account which is cross margin, and what that means, if anyone knows what that or doesn't know what that means, it means that we have a master account which is a main account, and we have the broker set up 3 separate sub accounts that link to this master account, and the dollars in this account are reflected in these 3 accounts. So that way, if we've broken the accounts up so they can trade long and short, because remembering that if we're in a trend trade in strategy 1, strategy 3 might be in a counter trend trade, so that one strategy might be long, the other one might be short. So we've got to have separate account numbers, but we want to take advantage of the fact that we've got the money in the account. We don't want to have to put in 3 times the amount of money just to trade the one strategy. We want to take advantage of the margin. So that was one of the keys. So let's go through this. The keys to success with the strategy was to really, our goal was to add net profits and reduce our maximum drawdown. So when we went through this process, we wanted to make sure, and this is just a formula, if you're trading multiple accounts, or you're trading two, say, systems, when you compare the two systems and run them side by side, so say you decide to trade two systems instead of one, the way you do that is you add the net profits, add the winners, add the losers, and you average all of the stats, except you do not average the max drawdown. You actually work out what your maximum drawdown is based on the days that you've traded. So because that maximum drawdown that you've got, if you're trading two strategies, is going to set up at different times, ideally. So you want to know exactly what the maximum drawdown is based on comparing the daily drawdown for both accounts. So let's have a look at how that potentially looks on our spreadsheet, and this is probably an easier way to describe it or take you through it. So I'll take you to our spreadsheet. So let's do that now. That's just one of our strategies there, and we're going to just pull up the DAX now, and I shall bring that over. Alright traders, so here is our live tracking sheet. So this is our live tracking spreadsheet. The strategies were, we had the trend trader, the cycle trader, the breakout, and we had a second cycle trader with a slightly higher time frame or a tick chart. Then we had that counter trend that I spoke about, the 55 tick, the nice quick counter trend trade. And you'll see here that what I've done up the top is I've actually put in the maximum drawdown that each account had between October through till the end of April. So the end of April, you'll see that I think I've left 1 day off there, 1 or 2 days there, or 1 day, but basically just a little bit of a heads up. So each of the strategies performed exceptionally well. So from October till April, the trend trader pulled 202 trend trader pulled 17,943. Its maximum drawdown, and this is the information that I want you to focus in on, because this is really key to the whole way in which this strategy and how to get the most out of your money management and your account and your growth. So if you're wondering where the money management information is coming in, this is where it is. So this is definitely a take-home piece. So the maximum drawdown here was 4,500 on that accountant system, and it made 17,943, which isn't a huge amount, but it's not too bad. Now the maximum drawdown on our second strategy was 3,500, a better drawdown, and around about almost the same net profit, so that was pretty good. That obviously would be more a much easier account to trade with a smaller drawdown. I'm sure we'd all agree on that. The 144 had a lot more trades. It had a bigger drawdown, 6,491. It produced a little bit more profit, not much more, and you're starting to get up in relation to your drawdown there. Again, with the 987, that was a fairly big. This is a very, very big tick chart. It's a swing trading tick chart, so it's going to potentially have a bigger drawdown, and it did. It was surprising. I thought it might actually be slightly bigger than that, based on the size of the ticks. But the performance was exceptionally good, 25,000 euro. Then we had the 55 tick, and it had a fairly big drawdown, and it had a net profit of 13. Now the interesting thing is that when I put these strategies together, so individually we would be all reasonably happy with the performance and drawdown on these based on obviously our starting account needs to be taken into consideration. If we started with 10,000, then we wouldn't be at all, we'd be, during the period where we were down 6.5, we may be feeling a little bit of heat, particularly if that was the first day we started trading. That wouldn't be too good at all, 65%. So, but, based on a 20, 30, 40,000 euro account, particularly 20,000, that's around about 22%, which for the futures market, trading slightly aggressively, is probably that a lot of people have that as their benchmark, 25-30% max drawdown. Because if you're going to start with a smaller account, then particularly trading a market like this, you're probably anticipating that you're going to take a little bit more risk. But let's have a look at how the strategies run when they run together. So the key thing here is that remembering that the worst trade